129 tons of gold vanished. And the reason France gave for emptying every ounce it stored at the Federal Reserve is the most revealing thing a central bank has admitted in decades. Not because it's honest, but because it's so obviously not. At the same time, gold collapsed 20% from all-time highs above $5,500, the worst weekly crash since 1983, during a war, during an oil shock, during exactly the conditions where gold should be surging. These two events are not separate. They are two visible pieces of a single plan. And what I'm about to show you explains who controls gold's price, how they moved it, and what the institutions who truly understand this are doing right now while everyone else panics. I want to start with something most investors never grasp. The gold market has two layers, and confusing them is the most expensive mistake you can make. First, there's the paper market. COMEX futures in New York, where contracts representing 100 Oz of gold trade constantly. This sets the price you see everywhere. But here's what matters. Approximately 95% of COMEX contracts never touch physical gold. They're paper claims, and the total value of those claims far exceeds the actual gold available for delivery. This isn't hidden, it's the architecture. The second layer is physical gold. London vaults, Shanghai exchange, central bank transfers. Less visible, far less discussed. But this is where the real signal lives. And what happened in these two markets simultaneously reveals everything. When the Iran conflict erupted, the CME group did something that sounds technical, but isn't. They shifted margin requirements from fixed dollar amounts to a percentage of contract value. As gold prices rose, margin requirements rose automatically, a structural amplifier built directly into the system. Then within 2 weeks, they raised margins 3 separate times. This created a lethal trap. JP Morgan, Goldman, HSBC, institutions with unlimited balance sheets absorbed it easily. Smaller hedge funds and retail traders couldn't post the collateral. They had no choice. They sold. Their selling drove prices lower. Lower prices triggered more margin calls, more forced selling. Prices dropped further, a liquidation cascade with nothing to do with gold's fundamental value. Ask the obvious question: who benefits? The well-capitalized institutions got to buy what small players were forced to liquidate at distressed prices. The exchange calls it a volatility review, but the outcome, small participants crushed, large institutions accumulating, was entirely predictable. That was force one. 3 others hit simultaneously. Turkey imports 90% of its oil. When conflict drove oil past $110 per barrel, Turkey's energy bill spiked billions overnight. With the lira fragile and reserves low, Turkey faced a choice: currency crisis or sell gold. Turkey sold between 60 and 120 tons in weeks. For context, total global gold ETF outflows during that period were 43 tons. Turkey alone exceeded everything being reported as the cause. Gulf states faced the same trap. Their dollar pegs required dollar reserves, normally replenished by oil exports. When Strait of Hormuz disruptions slowed exports, the gap had to be filled by selling gold. The outflows from London LBMA vaults matched Gulf sovereign selling in scale and timing. Force 3 was the dollar, and this is counterintuitive. During acute crises, global capital floods into U.S. treasuries. That strengthens the dollar. Since gold is priced in dollars, a stronger dollar mechanically suppresses gold for non-U.S. buyers. The chain ran like this. Conflict drives oil higher. Oil drives inflation up. Fed can't cut into inflation. Elevated U.S. rates attract capital. Dollar strengthens. Gold falls. Algorithms programmed to sell when real yields rise execute at scale. The cascade fed itself. Now force 4, the one that reveals the strategic logic. 129 tons of French gold sitting at the Federal Reserve since 1920, removed completely between July 2025 and January 2026. The official explanation from Banque de France? The gold was old, non-standard, didn't meet current specifications. France sold it in New York and bought compliant gold in Europe, now stored entirely in Paris. This explanation does not survive scrutiny. Every prior repatriation, Germany from 2013 to 2017, Netherlands, Austria, was done by physically shipping bars. Standard transfers, nobody sold and rebought. That's not how you move your own gold home. That is how you convert a claim on gold into cash and buy gold somewhere else. You only do that if physical transfer is impossible, either because logistics are prohibitive, which they're not, or because the gold you're claiming cannot actually be delivered. Let me be precise. This is interpretation, not established fact. The interpretation is France requested repatriation, found physical delivery wasn't possible, accepted cash settlement, and agreed with the Fed on a cover story describing it as compliance upgrade rather than failed delivery. Both had every incentive to agree. The Fed doesn't want to acknowledge delivery failure. France doesn't want to acknowledge its holdings may have been compromised. What's not interpretation is what happened next. Prominent German economists immediately called for Germany to repatriate its gold from the United States. A former Bundesbank economist said on record that storing gold in the U.S. carries geopolitical risk. Germany still holds approximately 400 tons at the Fed. That debate is now active. This rhymes with 1965. De Gaulle dispatched a French battleship to New York to exchange dollars for gold under Bretton Woods. Other nations followed. The outflow became so severe that by August 1971, Nixon closed the gold window. The Nixon shock, the end of Bretton Woods. The beginning of the dollar reserve architecture that has governed global finance for 50 years. I'm not predicting a repeat, but the dynamic, foreign sovereigns losing confidence in America as custodian of their gold, is structurally identical. Here's what was happening in the physical market while paper crashed. COMEX registered inventory, gold actually available for delivery, fell 25% during the price decline. Physical gold was leaving the system at an accelerating rate precisely when paper price was most suppressed. Physical gold doesn't disappear because a futures contract was sold. The metal is real. The paper claim is not. Meanwhile, in China, something occurred that received virtually no Western coverage and is one of the most significant gold events of the decade. China's regulators authorized 10 major insurance companies to invest up to 1% of total assets in gold. 1% sounds modest. These institutions manage trillions. Estimated potential demand from this program alone is approximately $27 billion. Half have already begun deploying. The industry is nowhere near its limit. If the pilot extends to additional institutions, which the framework explicitly contemplates, the scale grows substantially. Chinese gold ETF inflows remained resilient throughout the period when North American ETFs hemorrhaged outflows. Shanghai premium over COMEX stayed elevated. The signal was unambiguous. At lower prices, Eastern institutional buyers were accumulating aggressively. This is the structural asymmetry defining this moment. Western paper participants facing margin calls were selling. Eastern physical participants, unleveraged with long horizons, were buying. The price Western holders panicked about was, from Chinese insurers' perspective, a procurement discount. This has a name. Transfer from weak hands to strong hands. Weak hands hold on leverage and can be forced to sell. Strong hands hold outright, treat declines as opportunities, and have time to wait. What we observed was mechanically engineered large-scale transfer. The engineering was done through margin policy. The beneficiaries were participants who controlled or could withstand that environment. Now the broader logic. In February 2022, the United States froze approximately $300 billion of Russian central bank reserves. The consequence quietly reverberating through every sovereign fund and central bank is this. Dollar reserves are not inviolable. They can be frozen. Their availability is conditional on your geopolitical relationship with Washington. Poland, Kazakhstan, Brazil, India, China, countries purchasing gold at the fastest pace in decades aren't betting gold will appreciate. They watched Russia and drew a rational conclusion. If your national wealth is held in a system controlled by a potential adversary, it's not fully yours. Physical gold in your own vaults, subject to no counterparty's discretion, is the only reserve asset that cannot be frozen, seized, or blocked. This is de-dollarization, not ideology. rational sovereign risk management, responding to demonstrated precedent. The second-order effects matter more than immediate price movement. COMEX inventory is declining. Physical demand from Eastern buyers and sovereigns is rising. The pool of leveraged Western paper holders who can be margin called is finite. Every liquidation shrinks it. At some point, the paper market's ability to set a price diverging from physical reality will reach its limit. When that constraint binds, convergence will be rapid and large. Here's the central challenge. Gold declined 20% from all-time highs. That's real and uncomfortable. But ask what actually matters. Did anything change about fundamental conditions? Did U.S. fiscal deficit improve? Did central banks reverse gold accumulation? Did physical markets signal oversupply? Did de-dollarization reverse? None of those happened. What happened was a mechanical event in a leveraged paper market, amplified by sovereign forced selling from an energy shock, operating through temporary dollar strengthening. The structural case was not changed. From a long horizon perspective, it was given more time to accumulate at lower prices. The investors positioned to benefit from eventual paper-to-physical convergence aren't watching daily COMEX price and reacting. They understand the difference between a mechanical paper event and structural change in the thesis, and have discipline not to confuse the two. Watch signals that actually matter. Vault inventory, physical demand, sovereign flows, paper versus physical divergence, not daily noise of a leveraged paper market that is by design not a reliable reflection of the asset it's pricing. France moves its gold to Paris. China authorizes its insurers to build the largest gold allocation in the country's history. Central banks across the non-Western world continue purchasing over 1,000 tons per year. CME adjusts margin policy to flush leveraged retail and allow institutions to accumulate at distressed prices. These aren't random. They're coordinated behavior of actors who understand the global monetary architecture is transitioning away from unipolar dollar dominance toward a distributed reserve system where physical gold plays a larger role than at any point since 1971. Whether that completes in 5 years or 20, nobody can say. What can be said is the direction is determined by forces not weakening, they're strengthening. The paper market is fighting a rearguard action against physical reality increasingly difficult to suppress. The plan is real, it's visible, and it's being executed right now at exactly the prices the paper market suppression created.